So tonight we're moving from some of the issues we were discussing the last number of weeks. For those who haven't been, we're largely to do with the ecological and planetary crisis. We were looking at things like the role of the university and how, certainly in my view, it is failing in its responsibility to rise to the challenges and opportunity. We had a fascinating discussion last week with Ross Mitiga in terms of, very apropos of the action by Extinction Rebellion against the Barclays in town, but also was a series of actions that Exor did about Barclays Bank, the biggest bank invested in fossil fuels in Europe. But Ross's discussion last week was around what are the implications. If the climate challenge is like war, what does that mean? Who's the enemy? You know, where are the leaders? What types of actions are required? In particular, and it may relate to what Martina is going to talk about now in terms of the other crises of personal indebtedness. At what point do we escalate our tactics to something different? You know, the proposition might be that, are we beginning to come to the end of the nicey liberal phase of opposition? You know, politely signing petitions, perhaps voting for candidates of your choice that you think are going to make a difference, or even actions like the Extinction Rebellion. And there is a connection with what we're going to be talking about there tonight, not least because if you're following my lovely southern dulcet tones in terms of connecting money to the climate crisis. And that's what we're going to talk about here is also money in terms of many of us have a poor understanding of money. The reality is, without stealing too much of Martina's thunder, perhaps in modern monetary theory, but it's a particular interest of mine, is that the government cannot run out of money because it creates it. But this idea there's no money is bullshit. There are real resource constraints on the economy, particularly in terms of inflation and so on. But this idea, and most of us have this rather simplistic, intuitively appealing but utterly wrong view of money. I'm going to melt your heads on this Tuesday night, but some of you already know what a monetary theory is. But basically, our model of the state and how it creates money is like ourselves as a household. We have to earn money through working or robbing banks or whatever to get the money to spend it. In the same way, we often think, oh, the state has to raise taxes or engage in austerity to cut and save and raise taxes to get the money. That's not how states financing work. States create money simply by spending it into existence. It destroys money when it taxes. That's a completely different money story. And it's a functional account of how money is created. You can draw different ideological views on it, left, right, and so on. But it took me a long time, a bit like myself and Martina were talking about universal basic income, and she's not really convinced of it and so on. I just said, this can't be true. But I am now satisfied, after 3 years of researching it, that actually this is a functional account of money. Now, this opens up all sorts of possibilities that I'm hoping Martina's talk tonight can open for us, particularly maybe in later talks, around where are we going to find the money for mass insulation of houses in Northern Ireland? It's there. The only issues are, do we have enough materials, the resources, the people, and so on? As Keynes, one of the few dead white guys that I think got a lot of things right, anything that is technically feasible is financially possible. That's, an issue. But before we even get to maybe talking about this in later sessions, I'm delighted to welcome Dr. Martina McAuley, whose PhD I was the intern examiner for some years ago, in terms of an issue that many of us have experienced, but I really hope, and I'm sure Martina would agree with me, I hope none of you have ever really experienced getting into debt. Many of us have at times your bank overdraft and so on, but the multiple harms that are caused by people getting into debt, psychological, there's even evidence that, children living in stressed households where debt is an issue, their brains are being wired differently as a result because of that. Never mind the fact that, as I constantly say to my students, partly by way of forgiving them for not being more radical, it's hard to be radical and often take action when you're in debt. debt is an incredible way of keeping people in bondage, which is why if you look at the Eventbrite page for tonight's talk, there is, it's not particularly, novel, the idea of somebody being shackled. Indebtedness is a way in which people can have their options constrained, including politically in terms of activism. I mean, one of the things that I think partly explains the much more vibrant, and we may come back there again, the vibrancy of civil society action in the 60s and 70s was in part because students were relieved of that debt. You were actually paid, not a lot, but you were paid to go to university and have your accommodation and so on covered. I think that freed people enormous amount. Look at now in our modern neoliberal university, you know, in terms of students having to get into debt, and where your ability to pay, not your academic ability, determines when you go to university. So this issue of debt is something that hides in plain sight. In my view, you know, particularly because I probably know where Martina's going to go with some of her facts and figures, and just letting us know the enormity of this challenge. This is a social emergency in terms of what we're looking at. We had a social emergency in the public health crisis of the pandemic, and we see the state operating, and the state will provide the money. Remember that. Why is there always money for war and not for the NHS? We should focus. But where do we see the same action on this silent killer? On this silent way in which our societies have become much less generous, because it's hard to be generous and open and creative and kind-hearted if you're living under the constant sense of debt. Now, don't think we can blame everything on debt, you know, my bad teeth or and so on, not everything. But I think an awful lot of our social ills are to do with this hidden way in which many of us are enslaved by debt. Never mind, you know, the more egregious forms of payday lending. I'm just talking about normal forms of debt through banks and other financial intermediaries. So, as many of you know, I don't do things by half. So that was a very short introduction. And so welcome Dr. Martina McAuley back to your alma mater, Til Debt Do Us part, a relationship with money and debt and its impact on equality. So let's give all a warm welcome.
My PhD was on neoliberalism and personal debt, and it's a sociological study of personal debt in Northern Ireland. And more recently, then I've been linking debt, just on my own thoughts and my own kind of reading, linking debt with the impact on inequality. So I'm really grateful for the opportunity to talk about this, because I'm kind of updating some of the stuff that was in my PhD, adding a wee bit to it. But what I'm presenting tonight is really just the context from my PhD. I'm not really going to talk about the actual research that I did. Maybe that's for another day, but I'm going to talk about the context. So I'm going to tell a bit of a story tonight, and it's going to be unbelievable in places, and you're going to want to question some of what I tell you. Maybe not, given what John said, that you might already be aware of some of these things. And I'm happy to answer as much as I can, but I have to come clean in that I'm not an economist. But as it turns out, if you want to look at money and debt, that's actually not a bad thing. So here's the first unbelievable thing that I'm going to tell you. And it was probably the most disconcerting finding for me when I was doing my research. But it's that mainstream economists don't include money, debt, or banking in their models. By and large, they're believed to be irrelevant to the models. They just exist, and that's all there is to know. So if you ever wondered why so many economists didn't see the crash coming in 2008, that was why. So the only economists who did see the crash coming were the ones that were looking at the accumulation of private debt in the economy. And one of those was Professor Steve Keen, who I had the pleasure of meeting a couple of times now. And I would encourage you to have a wee read of this book, Debunking Economics. It's quite an eye-opener. So the story I'm going to tell you tonight concerns our relationship with money and debt, and why that's important from the point of view of rising economic inequality. And along the way, I'm going to have to talk about things like neoliberalism and capitalism and financialization, but I will keep it as untechnical as I can. I'm not going to lie, there are going to be a few graphs, but again, I'll keep those to a minimum. But most importantly, I'm going to talk about how money is created by private banks. And that might be the most unbelievable bit of all, but let me introduce you to one of my favourite quotes that I came across when I was doing my research from a bona fide economist, by the way, J.K. Galbraith. In 1975, he said this: "The process by which banks create money is so simple that the mind is repelled. Where something so important is involved, a deeper mystery seems only decent." So when I started on my PhD journey, I wanted to look at our relationship with debt, and I genuinely thought that it was going to be a social problem, personal problem type of analysis, focusing on why debt is used, what it's used for, and why it was increasing so rapidly in the run-up to the financial crash in 2008. Was the orthodox story true, that people just got a bit exuberant in their spending, took out too much credit, and then became problematic for them to repay it? And there is some truth to that, but it's not the whole truth. I needed to think about why suddenly there was so much more money to lend out. And I quickly figured out that in order to look at debt, I needed to look at money first. I needed to look closely at the economic and political system, which is built around money. The financial crash of 2008 that I mentioned there exposed the level of debt at the heart of capitalist economies around the world. My starting point was that personal debt is primarily a social relation which has a major power imbalance built in. That is, a power imbalance between creditor and debtor. And the source of that power lies in the ability of deregulated financial systems in this neoliberal era to create money as debt, and in the process, making economic inequality worse. There was an addiction to debt, all right, but it wasn't necessarily individuals who were addicted to it. So let's break that down a bit, and I'm going to invite you to come down a little rabbit hole with me. And I promise not to get us lost, and I hope that some of it is interesting too. So I'm not going to dwell too much on neoliberalism. It's kind of, I've described it as like the Voldemort of ideologies. It's the one that dare not speak its name. And if you haven't heard of it, then it's because you've been just busy living through it. Its history is fascinating, and I'll look at it in brief in just a minute. But in a nutshell, in terms of the neoliberal economy, it can be characterized by a predominance of the market. So it's profit before people. And in the deregulation of the financial sector, or more properly, has been described as re-regulation of the financial sector in favour of financial markets. So in this new deregulated era, it's characterised by the securitisation of debt-based financial products. And we'll talk a wee bit more about that in a bit as well. Banks were then freed up to create unprecedented levels of money as debt. And I'm going to talk briefly about neoliberalism and then about the role of money creation. A very brief potted history of neoliberalism. The birth of neoliberalism can be traced back to the work of economists Friedrich von Hayek and Ludwig von Mises, who founded this Montpellier Society in 1946. And it does sound a bit like a conspiracy theory, but I promise you it's true. This was just after World War II, and this secretive group was formed by invitation only, and it was named after the Swiss resort where the first meetings took place. The group included highly influential economists and centred on an embrace of classical economics and a rejection of the dominant Keynesian economics at the time. It was based on the work of John Maynard Keynes that John mentioned there. So the spread of neoclassical, this 19th century classical economic ideas, and the increasing dominance of the Chicago School of Economics, which was led by Hayek's student, Milton Friedman, ushered in an economic era which really began in earnest in the 1970s, so several decades later. And they took advantage of the economic crises that marked that decade to advance this market-oriented right-wing economic ideas, which became accepted as orthodoxy by the mid-90s. And a big part of that acceptance was due to the US-led global movement towards deregulation, which was termed the Washington Consensus. That's really just a set of recommendations that were aimed at promoting global freedom, prosperity, and economic growth through deregulation, liberalisation, and privatisation. And neoliberalism really began as a utopian intellectual movement in the 40s and 50s. It was a sort of intellectual talking shop, but it was aggressively politicised by Reagan and Thatcher in the 1980s, and it firmly overthrew the post-war Keynesian liberalism. Tony Blair in the UK and Bill Clinton in the US, despite representing nominally the left in politics, continued in furthering the neoliberal project. The new left appeared to be confirming the by now ostensibly apolitical nature of neoliberalism. And there was some guy called Professor John Barry that said that neoliberalism crucially depoliticizes the capitalist market. It came to be accepted as common sense. And it's still very much alive and well and apparent in our economy today, although it did get a bit of a drubbing recently with the overthrow of trusts in quarantine. But there are still plenty of people who agree with Thatcher's proclamation that there is no alternative, this TINA, for known for short. So in answer to how this neoliberalism has become the dominant policy, economic policy agenda of our time, Jason Hickel argues that this has been accomplished in a number of deliberative ways through the decimation of organised labour, the rise of consumer mentality aided by the growth of mass media, and the increase of corporate political lobbying. But the neoliberal experiment has had now several decades, several unregulated decades to prove itself, and it has failed miserably to do so, at least for the majority of the population. And Hickel argues that its strange non-death is due to the fact that while neoliberalism has indeed failed as a tool for economic development for the many, it's worked brilliantly as a tool for restoring power to a wealthy elite, the power that was seriously diluted by post-war economics in the US and the UK in particular, due to the dominance of John Maynard Keynes, which lasted until well into the 60s, really. And that's something to bear in mind about inequality. And I actually overheard Tony Atkinson saying this at a conference that I was at, that he said that you have to be careful about it because it works incredibly well for some people. And they tend to be the kind of people who have the ability, as I would say, the ability to pay to play in politics. Their ideas can trickle down in ways that their wealth never will. So we'll talk about this idea of money creation. We need to take a brief sidestep into money creation. And again, it's another topic for another day. And briefly, money's created in only two ways: by the government spending it or by banks lending it. I'm going to look very briefly at the government bit, as John mentioned earlier. Very interesting in terms of modern monetary theory, but I'm more interested in the bank bit, which they tend to leave out. So the government creates money as cash via a mint, but that only accounts for around 3% of the money in circulation. They also create money by spending on public services and infrastructure or on tax breaks. Government creates money to pay for good things like furlough schemes and bad things like wars, although there always seems to be more money for wars than for good. So the truth is that there really is a magic money tree in this way, but the decisions on how to use it are purely political and ideological. And it's very much understood, not understood at a political or public level. Corbyn, his economic team, actually came closest to accepting this view of money creation. And if you look closely at Biden's policies in the UK, I suspect he's got a few modern monetary theory people in there. So as an aside, modern monetary theory is really starting to gain some ground, and it's really just an explanation of how the monetary system works in practice under a sovereign money system, that is, a system that's based on fiat currency. And what does that mean? Well, the US, the UK, and Japan, for example, examples of sovereign money systems, they have their own currency and they are the currency issuer. A fiat currency is one that's not based on anything other than trust. And we've been living under a fiat currency since the end of the gold standard in the 1970s, when currency was floated rather than pegged to a measurement of gold, which is a finite resource, which in itself doesn't really make much sense anyway. I'm not going to go into what happens when a government creates too much money, because inevitably the Weimar Republic and Argentina come up in those discussions. But those are very specific examples with very good MMT explanations that are to do with the impact of foreign debt. But what really matters is that what the money is created is used for. All governments create money, but they do not all put it to good use. If you're interested in learning about modern monetary theory, I'd recommend Stephanie Kelton's book, The Deficit Myth, or there's a really excellent MMT podcast. I'm a bit addicted to it, actually, at the minute. I have a few quarrels with MMT, as I mentioned, but they're minor and they're focused on their analysis of bank-created money and the insistence on a role of a job guarantee instead of a universal basic income, which I'm still on the fence about, but I would favour over a job guarantee. Anyway, the other way for money to be created, and the one that I'm interested in, is by private banks who create it under licence from the government and lend it to individuals and businesses And this is the way that's been favoured in the neoliberal economy, in which banks have been incentivised to create the majority of the money in circulation as private debt in order to gain from the profits made in the form of interest and fees. And in order to create debt-based securities, which are tradable and which can also be held as assets. So the thing is that this private debt doesn't get added to the UK government debt figure. And so it sort of papers over the cracks, which are left by the inadequacies of government spending. And Professor Steve Keen shows when the government reduces spending and so avoids getting into more debt, as they're seemingly about to do again with austerity 3.0, private debt tends to expand. If you look at a graph of the two, they're sort of an inverse of each other, which I forgot to include in this, but trust me, they're an inverse, and I'll be happy to send that to you. And so we'll take a closer look at banking then. Stepping back further into the rabbit hole, there are three theories of banking which are related to how money is created and circulated in the system. And each of these theories has held sway at different times in the past, with the current mainstream economic theory centering on this banks as intermediaries theory, with the fractional reserve theory also getting mentioned occasionally. But contrary to most economic textbooks, a bank loan is not a transfer from depositors to borrowers, from the patient to the inpatient, as this banks as intermediaries theory suggests. This theory was debunked by economists like Professor Steve Keen and Professor Richard Werner, but it still persists in mainstream economics among a lot of Nobel economists as well. I use that very loosely because it's not a Nobel Prize. And whilst there's some truth to the fractional reserve theory, which contends that individual banks can't create money, but the system as a whole does, because of the very small amounts of deposits that need to be held relative to the amount that could be lent out. But sociologist Mary Mellor has argued that, contrary to popular opinion, there aren't really any effective controls over the amount of reserves and what those reserves are made up of. And she argues that it's a very grey area where debt-based securities form a significant portion of reserves, meaning that effectively the whole system is actually built on debt. And these sandy foundations were briefly exposed by the financial crash and just as quickly covered up again by the bank bailouts. So the credit creation theory centres on the creation of money as debt by individual private banks who profit from the interest and fees on the debt, as well as the ability to trade on debt-based securities. Debt is therefore always effectively the creation of money, as Anne Pettifor described it, out of thin air. This is the bit that really freaks people out, so I'd be happy to take some questions on it later on. The credit creation theory is actually the oldest of these three, having been around for over a century, and it does make for uncomfortable reading. As our friend J.K. Calvert said earlier, a deeper mystery does indeed seem to be facing. But fortunately, you don't need to take my word for it. This is from none other than the Bank of England, who very timely for my PhD research in 2014, when I was just starting out, brought this paper out on money creation. And they said most of the money in circulation is created not by the printing presses of the Bank of England, but by the commercial banks themselves. Banks create money whenever they lend to someone in the economy. And in contrast to descriptions found in some textbooks, the Bank of England does not directly control the quantity of either base or broad money. And it goes on to say that 97% of money held by the public is in the form of deposits with banks, not currency. So this graph, we were talking about broader based money, this graph has been referred to as a smoking gun because it clearly shows that bank created money, i.e. debt, was driving the growth of money for the past few decades, and particularly since the Big Bang in 1986, which refers to a period at which the banks in the UK were really let loose. And it was a high point for neoliberalism and a major point of deregulation in the financial sector in the UK. So what's the problem? I hear you say, isn't it a good thing that more money was created? Didn't they just grow the pie? Unfortunately not. Most of this bank created money was in the form of mortgages. So what this was doing was driving up the cost of housing, and as a knock-on effect, driving up the cost of rent. And here's the weird thing about relying on banks to grow the pie by creating money as debt. They only create the debt and not the interest. So whereas interest has to come from elsewhere, it has to come from your earnings. And in a way, debt could be seen as a sort of saving in reverse. You're really borrowing from your future earnings. But because the interest is up to us to find from our earnings, that's just sucking money out of the pay packets of borrowers. And unfortunately, we need to go a wee bit further down the rabbit hole and look at what interest is. And I need to take a brief step into accountancy as well, but I won't take you there for long. I promise.
Thanks for the trigger warning.
It is a trigger warning. So what's the problem with interest? But that's a very good book, by the way. It was actually called The Problem with Interest. And isn't it just a reasonable cost of doing business? The banks take a risk in lending, so they need to be compensated. Well, interest was outlawed before the 13th century, and it's still outlawed in some parts of the world. And I'm going to take you on that wee brief sidestep in the accountancy before we talk more about interest. Back before modern accountancy, bookkeeping was really just storytelling. It was a narrative. It was all done through words without much of a look in for numbers. In fact, the major innovation was in using numbers. But let's face it, modern accountants are still just telling a story. It's just one that most of us can't decipher. But the whole point of the story back then was to convince the reader, in those days the reader was the church, that the interest on any loans was justifiable. They weren't engaged in usury, which was outlawed. So one of the major innovations in accountancy was double entry bookkeeping, which was introduced in Italy in the 15th century by the Medici bankers. And it was a way to get around the usury laws of the church. It was used to convince the reader that the interest charge was merely representing the money that could have been spent by the lender and which simply gets added onto the loan and repaid by the borrower. So double entry bookkeeping became the norm by about the 19th century, and it's now the foundation of modern accountancy. And it turns out that it's really important when it comes to looking at debt. Steve Keen's actually really good on this. He's got some really good stuff on YouTube if you want to check it out. So when money is created as debt by private banks, a couple of double entries are made. One represents the asset, which is the loan made to you, which you'll pay back, and one to represent the liability, which is the deposit in your bank account for the same amount. When the debt is paid back to the bank, that asset account is cleared, as is the liability side. The money that was created when the loan was made is effectively destroyed, but there's another part of the transaction, and that's the double entry that represents the interest of the loan. The bank gets to keep this interest as pure profit, and it's profit on something that costs them practically nothing to create. So the link between money created as debt and the rise of inequality has to be seen in terms of this interest, which is effectively on the rent that's created. And that's extracted by the financial sector, and it's appropriation by a minority. Professor Michael Hudson makes this connection clear in his work in the financial sector, which he describes as an extractive industry. It's not extracting minerals or fossil fuels, but it is extracting money in the form of interest. And it turns out that the benefits from this interest is really important in terms of inequality. So you may not be alone, but if you have one, you are an interest-bearing asset. And the bit that bothers me about knowing this is that in 2008, there were some enlightened economists who were calling for QEP at the time, quantitative easing. In other words, using government-created money, which is free, to pay down debts or to cancel some debts, to reset mortgages, etc. Banks would still get the money that they lent out back, and people would have less to worry about, less interest to pay. The point is that that was never the point. Instead, we got quantitative easing. The banks got bailed out, and those sandy foundations were shored up, but loans were by and large not adjusted in any major way. Only really bad debts were struck off their books, but they didn't cancel debts for the most part. They went on collecting interest because it's only the interest that matters. It's the reason why in a default situation, a lender will likely prefer to restructure and receive something rather than nothing in order to keep the loan in their books, even reducing the payments to a bare minimum because they're still collecting the interest on that loan. And the need to keep interest-bearing assets going is also the reason why you'll get offers to roll over credit card debts, and you're encouraged to pay only the minimum of the credit card debt. The point is that the loan amount itself isn't as important to the bank as the interest it gets on making that loan. With the bailouts after the financial crash, the banks could start all over again, and interest rates were lowered to encourage people to start borrowing again. And there are signs of a return to excessive lending since at least 2017. And we'll look at some eye-watering figures in a bit, but basically in 2008, total outstanding private debt in the UK was just under £1.4 trillion. It dropped a tiny bit in the next few years, but probably as people tried to pay down debt and maybe avoided taking on more debt and the housing crash. But by 2014, it was back up to where it had been just before the financial crash. And each year since then, it's been increasing. The latest figures have outstanding private debt at £1.8 trillion, and that's a lot of interest that's being collected. So what happens with all of this interest? Why is it important? And how does it affect inequality? And I need to bring you a wee bit further down the rabbit hole into what sociologist Susan Strange called casino capitalism. So in the run-up to the financial crash, there was a major shift in the banking sector. Prior to deregulation, banks were kind of the way we think of credit unions now. They were local, they were personal. The manager had knowledge of their customers and made decisions based on that knowledge. There was risk involved, but it was carefully managed. Then deregulation happened, and suddenly this steady, boring community bank approach became a business. It was all about attracting customers and selling a product. In other words, they were selling debt and other financial products. And into this staid and boring world of finance came a new breed of banker. Enter the wizards of finance, known as the quants, or referred to as the quants. Starting around the 1990s, physicists, mathematicians, and computer scientists were mass recruited into what Michael Hudson refers to as the FIRE sector: finance, insurance, and real estate. We saw the birth of incredibly complex financial products, and a veil dropped in front of it all. It was impossible to figure it all out. In fact, the growth of computing capability during this time also played a major part. And we've become so dependent on financial experts who understand this opaque system that they're accepted as necessary for the functioning of financial aspects of life. The use of numbers and economic models in mainstream economics gives authority to the discipline, and it establishes economists as professional experts. What Steve Keen calls this kind of mathematics. Usually when the stats come out, most of us run a mile. And maybe this means that we've surrendered to those who understand it all. For better or worse, we've been held in thrall to these financial wizards for the best part of 4 decades. If you want to get a handle on this, I'd recommend John Manchester's book as a really good introduction. It's funny and readable. And the documentary Inside Job explained the system really well. And there's also the really good movie, The Big Short. These smartest guys in the room types ushered in the birth of what seemed like a great idea at the time: securitization. I'm not going to go into the workings of securitization in any kind of detail that would do it justice here, but basically it's the means by which loans are pulled together into debt instruments, which are then sliced and diced, and the rights to the interest are sold off to investors. They're mostly savers, wealthy people, and pension funds. And so risk is spread. It's actually a great idea until too much debt is created and there are mass defaults, which is what happened in 2008, particularly around the selling of subprime mortgages. It's also the phenomenon that underpinned the housing boom and bust. So securitization in and of itself isn't really the problem. Rather, the problem is the type of debt that's being sliced and diced. If instead of lending for ever-increasing house prices, we'd focused on productive credit, for example, lending to businesses to increase production and increase innovation, then that could be good for the economy, particularly if it was directed at the green economy. Debt for consumption or for investing in housing or other assets both reduces future spending power for those repaying the debts, and it drives up those asset prices, making it harder for future borrowers to buy a house. At least those who don't have access to the bank of home. That's another story for later. It's a sort of negative feedback loop. And I stress in my research that not all debt's bad. It's just important to regulate what it's used for. And neoliberals really don't like that R word. So the key to the solution for this has been outlined by a few heterodox economists like Richard Werner and Josh Ryan Collins as a managed system of debt, which assures that the majority of the money that's created as private debt is lent out for productive purposes, employing what Werner refers to as credit guidance. And it's been used successfully in Japan, for example. In this context, securitization makes sense, and debt is used in a productive rather than a very extractive way, and it reduces the need for occasional variance. This process of slicing and dicing of risk has been referred to as weapons of financial destruction. For example, if you have a mortgage with a bank, it's very likely that they don't hold your mortgage anymore. It's been sliced and diced and sold off and packaged up with my mortgage and everybody else's mortgage in this process of securitization. The interest is collected and distributed. Distribution is managed by the bank, which gets to keep a fee for that part of the service. But your interest payments are actually going to a whole host of investors, the individuals and organisations that have bought the rights to your interest, along with the rights of thousands of other mortgage interests. And the ownership of those little bits of interest that are all bundled together really matter in terms of inequality. So the owners of those little bits of interest are financial investors, including pension funds, but they're largely comprised of a financial elite at the top end of the wealth distribution. As Owen Flaherty showed in 2015, top earners have not only managed to capitalise on the opportunities offered by deregulation, but to sidestep the absorption of their income by the redistributive mechanisms of the state. What I mean by that, they get to avoid paying tax because this is unearned income and we don't pay as much tax on unearned income. On capital gains, we don't pay as much as we pay on earnings. But this financialisation has had a profound cultural impact. So even if you're not actively engaged in borrowing, the reality of our economic lives is that the economy rests on a substructure which is designed to allow the financial world to extract a thin slice of capital every time it slides across their desk, in return for ensuring that money moves smoothly around the system in the most efficient way possible. Margaret Kennedy estimates that around 35% of everything we buy goes to pay interest, which goes to bondholders, bankers, or financiers, because of the mathematics of how our private banking system is set up. She argues that this happens because tradespeople, suppliers, and retailers all rely on credit and debit systems, payment systems, as well as credit facilities for businesses. And the cost of these is passed on to the consumer. So this means that even if you're not borrowing money yourself, the effect of the system, which depends on credit in order to operate, ensures that everyone is affected by the cost of that credit. In this way, the story of debt applies to everyone, even if they be either a lender or a borrower. So this graph is sometimes referred to as the suspension bridge graph, and it shows the income share at the top 0.1% between 1910 and 2010. And here you can really see the impact of those post-war Keynesian economic years. And you look at how the share of income for the very wealthy around here from the 40s through the 70s. It stays fairly constant until the dawn of the 80s. And we were talking earlier about that Thatcher-Reagan economic revolution that started at this time. Since the 1980s, the top 0.1% have increased their share of income in the UK and US in particular. And that's largely due to unearned income in the form of income from financial investments. And what do we mean by financial investments? It's the debt of the rest. So the total interest paid in the UK per year on personal debt, including mortgages, is £48 billion. That's £132 million per day in interest payments on debt. That's all money that's extracted as interest that goes directly into adding to the wealth of those who are already wealthy investors, which I know includes pension funds, etc. But what if that money was lent out by a nationalised bank and all of that interest was collected by this national bank and used to fund something like pensions? So this is the graph I showed you earlier about new money that's created as debt since the 1960s. But what I also told you that money is created by private banks, the debt gets destroyed when the debt is cleared. So what is this graph really showing us? Is it showing us the growth of debt? Banks are creating ever more debt because as debts are paid down, new ones need to be created to take their place and provide more income for the financial sector in the form of profits from interest and fees. So the financial system as it currently exists depends on an expanding demand for credit. Throughout the 20th century, economic downturns and recessions throughout the world were invariably preceded by a rapid increase in credit growth. And the more rapid the increase, the deeper the downturn. If you're interested in that, there's a really good book by Richard Lee that spells this out. He used to be a financial, work in the financial sector. It's kind of been turned. So the credit creation theory of money rests on empirical evidence that shows that the majority of the money in the economy is created when individuals and businesses borrow money from the financial sector and that this money is destroyed when loans are paid down, which is all well and good. But when we add to this the expectation that the economy must grow, then this means that in the absence of government creating money free of debt by spending on services and infrastructure and distributing money directly to citizens, which also leads to growth, then there must be an ever increasing amount of private debt in the economy in order for the economy to grow. And just to be clear, I'm not saying that it should grow. That's a topic for another day, because infinite growth in a finite planet just won't. But the need for debt to keep growing means that this increased debt could be in the form of new loans or new ways of inserting debt into the social system, like the innovation of student debt in the 1990s. Or the increased debt could come from existing borrowers taking on more credit, as well as rolling over credit or increase in house prices, so as not to destroy money by paying off debts. Whatever you do, make sure that there are plenty of borrowers in the system. So this graph is from the Money Charity. This is one of the ones that I had to update, and my eyes were watering doing it. So it's from the Money Charity. They use figures from the Bank of England. And here you can see that at the end there, that £1.8 trillion figure that I mentioned earlier, in the context of the last 30 years. Despite all the calls for debt to be reduced since the financial crash, look at where we're at, way higher than it was in 2008. In fact, since 2008, when total UK debt was just under £1.4 trillion, we've added £400 billion to it, which was the total amount of debt that there was in 1994. And it's largely driven by secured debt, which is the blue section of the bars here. In other words, it's largely mortgage debt. And that doesn't mean that there are way more houses and way more people buying them. There are some more houses and there are some more people buying them, since there were in 94 when this chart starts. But this extra borrowing represents mortgage lending for ever increasing house prices, as well as for equity release. Think of the average new development in 1994. Say we had 100 houses in it, all sold to first-time buyers. Assuming they all got mortgages at 90% and the house cost 35 grand. That's just over £3 million of mortgage debt in that development. And I'm using average house prices here. Now consider similar development now, 100 houses in at, let's say, 180 grand each, is about the average price now. Again, all first-time buyers and all 90% mortgages, as if first-time buyers will be able to buy this. But anyway, let's stick with the figure. So that's £16 million of debt in that same development, the same size and same type of development. Inflation would only account for around 2.5 million of that increase. The rest is debt inflation. Are the new houses worth 5 times more? Clearly they're not, because it just said that they were equivalent in size and type. But those first-time buyers are now expected to pay 5 times more for the same thing their parents got for a lot less. However, mortgages aside, consumer credit is also significantly higher in recent years. That's the wee green section at the bottom of the bars. And you can see a bit of a dip in the few years after the financial crash, but it's back up to where it was before 2008. And the Money Advice Trust estimates that over 15 million households in the UK have used credit to pay for essentials this year, an increase of 2 million households just since March 2022. So how does all this look on the ground? As of July 2022, total outstanding private debt in the UK, as I said, including mortgage loans and credit cards, was £1.8 trillion. And to put that into perspective, when I was doing my research in 2017, that figure was £1.5 trillion. And in the run-up to the financial crash in 2008, it was £1.4 trillion. It's made up largely of mortgage debt, as we saw in that last graph, but outstanding consumer credit cards, loans, credit cards, things like that, in July 2022 was £204 billion. And that July figure was up by £1 billion from the figure in June. In other words, consumers borrowed £1 billion more in 1 month this year. The outstanding consumer credit figure amounts to an average unsecured debt, so not mortgage debt, of £3,864 per adult in the UK. But bearing in mind that that's an average, so it's based on the total number of adults in the UK, but not all adults have debt. And you can be sure that the amount for the individuals who have debt is a lot more than 3,000. The total debt per household, including mortgages, was just over £65,000 in July 2022. But again, this is an average, and it's based on the total number of households in the UK. But you have to bear in mind that around a third of households own their property outright, So again, this figure is an average that hides an awful lot of important detail. There's a lot of debt out there still, and it's by no means evenly distributed. So in order to do justice to researching personal debt, I haven't really gone into detail on the research that I did. This is all about the context for my research. I had to take a more complex view of debt, one that cut across disciplines, from history and economics, behavioural psychology, and my own discipline, sociology. Much of the literature on over-indebtedness refers to the propensity of individuals to engage in risky financial behaviour or impulsive behaviour, with the emphasis on personal psychological traits given as a reason for individuals to become over-indebted. Whilst behavioural economics provides a slightly better lens through which to view debt accumulation, particularly in relation to loss aversion, this concept of loss aversion, the economic context in which this behaviour, this borrowing takes place, is rarely considered. These theories were preferred in the run-up, government research in the run-up to the financial crash. Then we've got a lack of financial capability. It's also a major theme of debt research, which tends to favour the view that over-indebtedness is caused by a lack of knowledge of the debt instruments and how to work out interest rates and how to work out the total amount we paid. And it's closely associated with educational attainment. And I was very critical of this approach in my research. The focus in this type of research tends to be in correlating over-indebtedness with people who are low incomes and those with lower educational levels. Financial capability has been the focal point of government reactions to over-indebtedness in the UK since the financial crash, but it again ignores the reality of debt accumulation among different household types and different income levels. And there are issues with how and at what level debt is defined as problematic. But more importantly, this approach lets the financial system off the hook entirely for the accumulation of personal debt. And it's steeped in what the late David Graeber refers to as the morality of debt. The life cycle model of debt regards over-indebtedness, this one was hilarious to read about, it regards it as an unfortunate feature for younger households. It becomes less of an issue once earnings are increased and debts are eventually paid off. And therefore, in this model, over-indebtedness really isn't an issue of concern. Whilst there's a kernel of truth in this model, it really doesn't hold up much against scrutiny. Young households today are facing much higher house prices in comparison to their incomes than households were in the 90s, as we just showed there. With the ratio now about 6 to 1 compared to 3 to 1 in Northern Ireland in the 1990s. And it's impossible to tell what kind of impact that will have as those households age. So particularly as wages are stagnating, real wages are stagnating in real terms. Also, we don't have the data to tell us that older people are in fact paying down their debt. We haven't collected household debt data in any population-wide level in Northern Ireland since 2009. We just don't know who's in debt and how much, but we know that there's a lot of it out there, and that overall figure we've seen, it's not going down, it's going up. And of course, once again, in this life cycle model, the financial system is completely left. But individuals don't make financial decisions in a vacuum. They make these decisions against the backdrop of an economic structure and a financial system that's outside of their individual control. Of course, I would say that it's sociology. So behavioural psychologist Richard Sapolsky stressed the importance of focusing on behaviour which is context dependent. He refers to psychological tools which have been honed through millennia of human evolution and which are available to individuals to help them deal with the constraints and opportunities in their current environment. And that environment is also evolving. So in this regard, borrowing in order to avoid losing face or to maintain or defend a lifestyle or just to pay for essentials, or indeed borrowing which is in order to signal wealth, so the keeping up with the Joneses type of borrowing, could be viewed as one of the tools available to individuals. And the environment that they find themselves in is this neoliberal era we've been talking about. And it's one in which credit is readily available and is actively marketed to people. And this neoliberal era is also characterised by a combination of an increase in consumerism and the financial constraints of a rising cost of living set against a drop in real wages. And it's debt that's accumulating in that gap. So combining these approaches then, as I did in my research, it could be said that in such a financial environment, individuals may be more likely to turn to easily available credit in order to fill the gap between income and expenses, or indeed between income and expectations. so as to avoid losing face by appearing to others as though they can't afford their lifestyle, either in terms of luxuries or necessities. But it's also vital to examine the role of debt in furthering inequality in society. And the rise of the rentier class in the form of this financial elite we've been talking about, for whom the build-up of personal debt in the rest of society has been a major benefit as they scoop up the interest rates in the form of unearned income, which they get to pay. So as David Graeber pointed out in his superb book, Debt, the First 5,000 Years, if you're in any way interested in money and debt, I would really encourage you to read it. Debt contracts have played a major role in exacerbating inequalities throughout history. And in recent history in particular, the meteoric rise of housing debt has enabled the funneling up of wealth. Interest, which is extracted from the rest of us, ends up in the hands of this class of investors, this financial elite. It's exactly the opposite of the trickle-down effect, this myth of abundance that was promised to us by the neoliberal turn. This famous champagne glass graph shows the unequal distribution of wealth in the world, but I've referred to it as a funnel graph, because what it really shows is wealth being funneled up from the rest of society to the richest fifth. As Andrew Sayer tells us, we simply can't afford the rich. Whilst it's important to take a biographical view of debt in terms of looking at who borrows and asking why, recognizing that it is a personal decision after all, it's just as important for us to be aware that those personal decisions made about borrowing are made within an economic and political structure and context that encourages and in fact relies on individuals and households taking on as much debt as they can afford and then some. And in a social context in which we're supposed to look like we've made it, like we're worth it. And we have to avoid looking like we failed to be part of this affluent society thing. And we're constantly reminded of the need for growth in the economy. But that growth, particularly when it's focused on the financial sector, depends on the growth of debt for the rest of us. So were we addicted to debt in the run of the financial crash, as I asked at the beginning? And are we just as addicted to it now? I think the language of addiction might be appropriate, but it's not necessarily individuals who are addicted. Perhaps it's the economic system which is addicted to debt because of the way that money can be created by private banks as debt, which forms the basis of investments for a financial elite, and the need for constant growth of this debt. We literally can't get away from building up more debt as the economy continues to be enthralled with this neoliberal ideology. I'm almost finished. Now, you'd be forgiven for thinking that I'm anti-debt and anti-credit, that I think that all debt is bad, and that's just not true. Joseph Stiglitz refers to credit as the lifeblood of the economy, and Anne Pettifor has argued that debt can and should be a good thing if, and it's a big if, the debt and the interest that it generates is put to good use. It can be used to smooth out expenditure over the course of a lifetime, but do I wish there was a social bank or a nationalised bank for this purpose? Of course I do. That way the interest wouldn't be driving inequality via this securitisation. Rather, it would be put to social use, as long as the Tories weren't in power, in which case it would be going to the top earners by way of tax cuts. So too much personal debt can and does bring misery. It can destroy lives. But debt, if used wisely, can be empowering too. And it very much depends what it's used for. The irony was never lost on me that in order to do my PhD, I had to borrow to undertake a master's degree. And that I thought was a good use of debt. But the elephant in the room, the bit we rarely talk about, is how dependent our current financial system is on debt. Individuals are criticised for getting into debt they can't afford. They're demonised. But rarely is the lender demonised, unless they're charging exorbitant rates, like RIP Wonka. But there are more Wonkas out there. But the truth is, the whole economic system is dependent on encouraging people to borrow. The low interest rates that were around for most of the past 10 years were openly talked about as a way to encourage borrowing. And interest rates have just been raised in the midst of a cost of living crisis. That's a lot of extra interest being sucked out of the economy right at the time when households need every extra penny to pay for essentials. It's absolutely maddening when you understand how money's created. But there's another story in there about UK monetary policy. And the truth is that this independent Bank of England is really only doing what its algorithm says it must do. When inflation goes up, interest rates must be raised, thanks to the success of that Mont Pelerin crowd I was talking about earlier, and influencing a whole generation of economic thinkers. And you'll hear a bit more about Tufton Street from time to time. You've probably heard it in the news. There are a lot of the children of Mount Pelerin, I would call them. But to those economists, it's a simple system. It's not a complex one. So it's a case of when the only tool you have is a hammer, everything looks like a nail. But the real world experience for people who are feeling the squeeze is that they need to get money from somewhere. And if they can access credit, even at higher interest rates, they're going to do so. Increasingly, we know that people are borrowing for ever more just for covering their expenses. And they're borrowing sometimes from illegal lending sources. In the run-up to the financial crash, it was understood that borrowers were accessing credit to bridge the gap between expectations, if you have a good lifestyle, and they're actually decreasing wages. But now we know that people are borrowing to bridge the gap between necessities and decreasing wages, real wages. Just this year, the Consumer Council for Northern Ireland estimated that the lowest earning households in Northern Ireland had on average £29 a week left after paying for essentials, their bills and living costs. That's earlier this year. In other words, that's before the cost of living crisis really hit. So what about our relationship with debt in this neoliberal era? It's not a marriage of equals. It's a marriage of convenience for a financial industry that has a debt grip on our economy. And it's fed into the rise of inequality. The word mortgage literally translates as debt grip. Far from viewing debt as a relationship between debtor and creditor, in which both have shared responsibilities, debt is an asymmetrical relationship, where individuals are targeted for advertising of ever more enticing borrowing opportunities and then blamed for their over-indebtedness. And the financial industry accepts no responsibility. In fact, it's lauded for growing the pie and being such an important part of our economy, too big to fail. So it's important that we examine our relationship with debt in this neoliberal era, an era in which the financial sector continues to require us to be willing and or needy borrowers in order for it to survive and to thrive in an economy where increasing debt is essential for growth. This has required us to accept debt as a normal part of everyday life and to take a vow that we'll honour our debts and obey the small print till death do us. That's it.